Good afternoon, everybody. Going to go over our Forex trades for today, Thursday, December 17th, one day after the historic Fed meeting yesterday where the Fed raised rates a quarter of a point as expected. Well, it was about a 75% chance that they were going to do it, and they did do it. We'll talk about that in a minute. We had two trades last night, nothing this morning, two that pulled out 4.7 pips on a size-adjusted basis. First, let's just discuss the economic numbers that came out this morning. Not a whole lot. Philly Fed came out this morning. It's the lowest level since February of 2013. That didn't sound very good. Initial jobless claims was a little bit better than expected. What else was there? The CEO of BlackRock, which is the largest, I guess if they're a mutual fund or hedge fund in the world, he was out on Bloomberg talking. He said that he believes Janet Yellen nailed it yesterday, that they could be quite slow in raising interest rates over the next year. He did say people working jobs that they don't want and don't have disposable income is a trend that we have to live with. Basically, he's another one of these guys admitting to the new normal. He says the economy is decelerating, but doesn't see a recession. So he's saying that the economy is decelerating, but the Fed is raising rates. It's almost like it doesn't make sense. It's almost like they're doing this for any other reason other than what they should be doing. We've been saying all along that they should be raising rates just to normalize them, create what we call good inflation. I know raising rates usually doesn't create inflation, but in the interest rate environment of zero bound rates, there's no incentive for investors. Therefore, then there becomes no incentive for corporations and municipalities or whatever to do projects, to issue debt, because they may not be able to do the projects that they want because they can't generate enough investment. So because there's no demand by the investors. So who wants to put their money in a muni bond earning 2.5%, 3.5%? There's just not. I mean, there's always a demand, but the appetite is not there. So therefore, whether it's a corporation or a municipality, they can't raise the amount of money that they want to raise. So it's not a good environment. So if you were to normalize rates, we've talked about this on numerous occasions, if you normalize rates, you can get it back to create, again, like what we call good inflation. But the Fed won't say that. They're insisting that the economy is strong, growing, and they needed to cool off a little bit. So therefore, they're raising rates. It's an absolute joke. Bank of America Merrill Lynch seems to be the one economist that actually gets it right. It's at least what we believe. They came out this morning. They said rising rates and falling profits are not a good combination for asset prices. We turned sellers of risk in 2016 was their actual quote. So they seem to be taking all the noise out from the talking heads on TV and Janet Yellen at the Fed and the other Fed governors, and they're just taking basic economics. You're going to raise rates while corporate profits are falling, but yet the economy is so strong. So you claim it's not going to be a good combination. Eventually, it's going to catch up with the market. The market itself yesterday jumped over 200 points, but you can't judge what happened by one thing. Now, what is extremely interesting, and this was not supposed to happen, okay? The spread on the 2s and 30s, the spread between the 2-year Treasury and the 30-year Treasuries actually flattened, okay? And the spread came down by 10 basis points, okay? And flattened that yield curve. The most it's been flat in the past 9 months. That was not supposed to happen. When the Fed's raising rates, the yield curve should be widening. So it's absolutely shouldn't have happened. And the market, you could even look at S&P financials, the ETF of S&P financials against the yield curve of the 2 and 30s, it's extremely wide, okay? And the last time it was this wide was this past August, which we had the market sell off, but then just, bounced right back. And when the market sold off, that yield curve actually started to rally, and it helped equities rally. But now the yield curve has rolled back over, and equities have continued to rally. So again, it happened yesterday. Look at it, right? The market itself was up 200, whatever it was, 225 or something. Yet the curve, the yield curve on the 2 and 30s flattened by 10 basis points. It's the complete opposite of what should be happening. So just something that we wanted to point out. This just screams, to me, this screams policy error. It screams that the Fed made a mistake. In fact, as of last night, I don't know about, actually as of this morning, the odds of the Fed lowering rates at the January meeting compared to the odds of the Fed raising rates at the January meeting were actually greater. So here the Fed just raised rates and the street expected it. And I know it's only less than 24 hours since the Fed did this, but you would think the odds of another Fed increase, and on top of that, the Fed signaled that they're going to be raising rates going forward in a slow manner in 2016. So you would think the street would say, oh, they're not kidding around. They raised rates yesterday. The most likely will raise rates again in January or February, but yet the odds of them raising rates in January is actually lower than the odds of them cutting rates in January. So it maybe the street is just so confused as far as that statistic goes. But the yield curve, not looking good. I mean, that could be an anomaly that it happened yesterday. But if you look at a chart of that yield curve compared to, like I said before, the S&P Financials ETF, they usually are pretty correlated. And that correlation has been widening since, I would say, it started widening in mid-October. The correlation started to widen mid-October and started to increase or accelerate that width during the month of November. Pretty much has stayed where it ended the month of November. It's pretty much stayed there so far all of December. So I don't know. I think that is screaming policy error. I'll tell you that right off the bat. So that's it. Let's get to our trades. Two trades, like I said, pulled out 4.7 pips on a size adjusted basis. First one you're looking at here is Aussie CAD. We were short this last night, 0.99171. We had 50% of our normal size. Picked up a quick 5.4 pips. Probably should have pieced out. Was tempted to piece out, but considering we were just getting back to trading again after the Fed meeting, and you had all this violent action on almost every currency pair while that announcement was being made, it could kind of throw things off with the algorithm and what it's calculating. So, I'm not saying it's going to throw it off massively, but let's just book the profits real quick. Things are going to get more normal tonight, Friday, Monday, Tuesday next week before the holidays. So we took the 5.4. As it turned out, we should have paired it out because it went right down to the figure of 99 even, and then tried to bounce. And our feeling about figures. It's just a big psychological level. And so far, it's been holding that psychological level. Then overnight, it bounced, and it came right back down this morning. But we'll take the 5.4, 2.7 on a size adjusted. Second one was pound dollar. This one was a little bit more difficult. We were short from 1.49692. We had 50% of our normal size. Picked up a quick 4.1 pips or 2.0 on a size adjusted basis. It looks easy on a 30-minute chart, but again, you're trading on a shorter time period. And it was just having trouble coming down, and you had all this violent action again, like I said, from the Fed. And you see this big tail down. So this big tail down is like 59. So here we are covering 65. Could maybe these buyers step back in? As it turned out, they didn't. It continued to break down within 15, 20 minutes after we covered, it started to break down a little bit harder. But hey, we'll take it. Profits are our profits. So 4.7 on a size adjusted basis, and we'll move on. So that's it. We're going to wrap it up. If any signals come out, they'll be coming your way. If you're still trading now, good luck. We'll be back tomorrow, assuming we get some action tonight or tomorrow morning. Have a great rest of your day.